No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. We're going to pick up where we left off last week. We're going to be talking about how you can, in fact, protect yourself with some of the things that we're seeing being forecasted with regard to the stock market and, for that matter, interest rates as well. So let me share some recent articles with you that may be of some help with that. In investment news, this is one of the periodicals I get. BlackRock, which is one of the largest, in fact, it is the largest money manager in the world with like $4.6 trillion under management. One of the reasons might be the federal government is one of their customers or clients, if you will. They manage the thrift savings plan for both federal employees and the military. So one of the things they're talking about is lower returns. Now, what do they mean by lower returns? I'm saying lower interest rates as well, by the way, and returns that are going to be less than 5%. They go on, in fact, to say that if a global portfolio, now this is something really important. I've talked many times about how the smart money invests, about Dr. Eugene Fama, Nobel Prize winner in 2013 in economics for his equity research in developing the three-factor model, which is quite, is becoming more and more broadly used with regard to investment portfolios. It is a proven method based on the math, the science, if you will, that's available to us over the history of the stock market. And through that, he's shown how, building on the work of Dr. Markowitz, who won the Nobel Prize back in 1990 for developing what is known as the Markowitz efficient frontier. And what that is, and I've shown it to you, and I'm going to show it to you again this morning, the efficient frontier simply shows how blending together certain asset categories in a portfolio, like stocks and bonds as an example, is a way to smooth out volatility. They have a negative correlation typically. When one's up, the other's down. That smooths out the volatility while attaining a desired rate of return. So, and that's the goal, is we want to smooth out, or if you will, reduce risk or volatility, so when the market drops, your portfolio doesn't drop as much. When the market goes up, of course, it doesn't go up quite as high either, but it's maintaining a tighter trading channel, if you will, that's going to make it easier for you to, for those in particular that have low risk tolerance, this is going to make it easier for you to stay disciplined with your portfolios. That's the concept, all right? Here's the problem, is that according to them, even a 60-40 global portfolio producing annual returns of just 3%, 3.3% over the next decade. Some say over the next 5 years, 8 to 10 years. If we look at the Shiller Index, GMO funds is another large fund family. They're expecting same thing. And keep in mind, by the way, when you're looking at historical U.S. stock returns of about 6.5% after inflation, then imagine all of a sudden what they're talking about is possibly a negative return after inflation. In other words, not stocks, which has always been, a stock portfolio has always been one of the go-to methods of staying ahead of inflation and taxes. All of a sudden we're seeing predictions, if you will, forecasts from some very some of the largest funds out there stating that that's going to be very difficult for them to maintain. All right, now there's other news on that front as well. This one was from McKinsey. Now McKinsey is McKinsey Global, McKinsey & Company. This is a very large data analyst company as well. One of the things they're looking at over the next, and I'm looking at my notes on this because I want to make sure I don't misquote it, but I also want to make sure you understand the kinds of things I'm looking at all the time when I'm working with my clients, when I'm helping you here today, is to show you what's coming, okay, to help you prepare, because it's not that these are negative things, all right? It's like anything. If you see a risk, then you do something about it. If you're worried about your family, if you were to die early, you go get life insurance. If you're worried that your house might might catch fire, you get home insurance. If you're worried you might have a car accident, you get auto insurance, all right? So there are ways that you can offset the risk, and that's what this is about, is showing you, okay, here are the risks. Now let's take some positive actions to protect you against that risk, so if it does happen, you're prepared. All right, so here's an example. First off, this chart, and I'm going to get this done in a graph for us, and I'll go in more depth in future, but we got so much to cover today, I want to jump into that too. So let me just share with you what they're looking at in U.S. equities historically over the last 100 years, about 6.5%. They're talking about down more around 4%. I've seen even predictions at 3 to 4. Well, here's something else. Guess what? Since 1999 through 2015, in fact, the S&P 500 index has a return of about 3%. So they're pretty much in line. They're saying that more of the same is what's to come. And when you look at internationals, European equities as an example, historically, again, around 6%, they're looking at, about 4.9%, they're looking at about a 4 to 4.5% return there as well. On U.S. government bonds, 1.7% historically, they're saying maybe 2%. What are you going to do with 2%? We're seeing that in this low interest rate environment, right? Even European government bonds, they're saying, which are higher risk, of course, and you're looking at about the same kind of return. All right. I'm hitting you with a lot, but I want you to see this isn't just one source, okay? So far, I've given you 3. Here comes number 4. Dr. Robert Shiller, who also won the Nobel Prize in Economics in 2013. And it's kind of interesting that the 2 winners of the Nobel Prize in 2013 in economics had 2 different views. One used asset allocation in developing the 3-factor model when it comes to investing in the stock market. The other, Dr. Shiller, developed what's known as the Shiller Index. Now, he uses a model. He has an index utilizing market sectors, things like consumer staples, consumer discretionary, healthcare, financials, technology, utilities, okay? So he's looking at the 10 sectors in the economy as opposed to asset classes. 2 different ways of approaching it. Both won Nobel Prize for their work. And when it comes to, think about this, we don't know. No one has a crystal ball, right? So if we know there's a lot of strategies, and there's more and more emerging strategies coming out today that we're seeing over the last, say, 8 to 10 years, and even in most recent, in the last 1 and 2, 3 years, more strategies coming out where people are trying to figure out this volatility thing, and coming out in very big names like J.P. Morgan Chase as an example, Shiller I just mentioned. Large companies and organizations that are coming together, Barclays Bank, BNP Bank, they're coming together and finding ways that they can smooth out volatility and give you better returns to help you stay ahead of inflation and taxes. And I'm going to share some of these new strategies with you as well. Now, according to Dr. Shiller, again, Nobel Prize winner 2013, the average average Shiller ratio, and it's been pretty accurate in predicting stock market returns. He's talking about an S&P. Now, think about this. The S&P is right about tickling at 2,100. Okay, he's talking about that dropping to 1,300. Okay, that's like a 35% drop in the stock market that he's predicting. The Dow at about 11,000 in keeping with that. So again, he's saying, and this is based on that Shiller Index, as I mentioned, that he developed, which has been very accurate. And in fact, the Shiller Index right now is at averages, I should say, at about 17. Right now it's at 27. Historically, one of the things that we're looking at when it gets to this level, the times it's happened before were like in the collapse of 1929, the bear markets of 2000 and 2007. So again, there's a lot of news out here that's saying, look out, we should be in for a rocky road. Another, John Bogle, he's the founder of Vanguard Funds. I've mentioned this before, predicts 2 50% decades in the market over the next 8 to 10 years. This is one of those when you're looking at what's happened historically. We learn right from the past if we're paying attention. So in 2000 through 2002, the stock market dropped 44%. In October of 07 to March of 09, the market dropped over 50%. This has happened before. They're saying it's going to happen again. All right? So low returns. Bogle also went on to say, expect returns in the U.S. stock market over the next decade to be around, at best around 4%. So there's a lot of people out here that are saying 3 to 4%. And guess what? The reality is, when we look at it from 2000 through 2015, over the last 16 years, that's exactly what we're seeing. And they're saying it's going to be more of the same. All right? Now, that's the bad news. The good news is we're going to take a break. When we come back, I'm going to jump right in and show you these new strategies, show you some things and some old tested strategies, show you some ways that you can protect yourself and, in fact, be able to maintain your standard of living, make money when the market goes down. All right, join me here. We'll be right back on the Retirement Report.